What if the most fragile moment in your financial life is the exact second you become successful? Not when you're broke, not when you're drowning in credit card debt, but the moment you open your banking app and see six figures staring back at you. $100,000. It sounds powerful. It sounds stable. It sounds like you've made it. But here's the uncomfortable truth. This is where most people accidentally sabotage their future wealth. Not because they're reckless, but because they relax. Let's talk about that moment. You're sitting in your car, engine off, maybe outside a grocery store or a pharmacy. You refresh your banking app, and there it is, $100,247. You don't scream. You don't post it on Instagram. You don't call your friends. You just stare. Because something unexpected creeps in. Pressure. Now you have something to lose. Now people have opinions. Now every decision feels heavier. Your coworker says, "Put it in crypto. This is the next cycle." Your uncle says, "Real estate. Land never goes away." A finance influencer says, "Index funds, obviously." And a quiet voice in your head whispers, "You've been disciplined for years. Maybe you deserve to breathe a little." That last voice, that's the dangerous one. Because the first $100,000 isn't just a milestone, it's a structural shift. Legendary investor Charlie Munger, longtime partner of Warren Buffett at Berkshire Hathaway, once said, "The first $100,000 is a boy, but you've got to do it." Most people focus on the suffering in that quote. They ignore the second part. After that, you can ease off the gas. What did he mean by that? Did he mean stop saving? Did he mean start spending? Did he mean you've made it? No. He meant something mathematical. At $100,000 invested at an average 8% annual return, your portfolio generates $8,000 per year. That's about $667 per month. Without extra shifts, without negotiating a raise, without working weekends. Your money now has its own income stream. And here's where things get wild. Let's say you continue saving $1,000 per month. Your first $100,000 might have taken 6 long years of discipline. Brown bag lunches, roommates, no car payment, saying no when others said yes. But your second $100,000? It doesn't take another 6 years. It might take 4. Your third? Closer to 3. Your fourth? Even less. Compounding is not linear. It accelerates. It's like pushing a massive boulder uphill for years. Painful, slow, exhausting. But once you reach the crest, gravity takes over. And here's the key. Once gravity starts working in your favor, your only job is not to step in front of the boulder. Yet, that's exactly what most people do. They make one of 3 mistakes, and none of them feel like mistakes while they're happening. Mistake number 1, playing it safe. After working so hard to build $100,000, the idea of losing any of it feels unbearable. So you park it in a traditional savings account, earning close to 0. It feels responsible, mature, conservative. But inflation historically averages around 3% annually. If your bank pays 0.5%, you're losing purchasing power every single year. Quietly, invisibly, you look at your account and it still says $100,000. It feels stable, but in real terms, your money is shrinking. Over 10 years, that erosion compounds in the wrong direction. Now compare that to a broad market index fund tracking something like the S&P 500. which has historically averaged roughly 8 to 10% annually over long periods. At 8%, $100,000 becomes over $215,000 in 10 years. At 10%, it becomes nearly $260,000. Same decade, same person, two completely different outcomes determined by one decision. Safety is not the absence of volatility. Safety is preserving purchasing power. Mistake number 2, trying to outsmart everyone. This is the ambition trap. You've got real money now. You download a brokerage app. You start watching investing videos at midnight. You read threads about AI stocks, crypto cycles, biotech breakthroughs. You think, if I just research enough, I can find the next big thing. But here's the uncomfortable data. Reports from S&P Dow Jones indices, known as the SPIVA scorecards, consistently show that the majority of actively managed fund managers underperform their benchmark index over long periods, often over 80 to 90% over 15 years. These are professionals with research teams, with Bloomberg terminals, with Ivy League degrees. If 9 out of 10 of them can't beat the market consistently, what are the odds that you will between meetings and Netflix? And it's not because people are dumb, it's because they're emotional. They buy after headlines, they sell after fear, they chase returns, they time things poorly. The gap between market returns and investor returns is often explained not by bad assets, but bad behavior. The solution isn't to try harder, it's to stop competing. Own the entire market through low-cost index funds. Accept average market returns. Because average compounded over 30 years is extraordinary. Mistake number 3, lifestyle creep disguised as reward. You've been disciplined for years. You skipped trips, you drove the older car, you split rent. Now you hit $100,000 and think, I've earned a small upgrade. A slightly nicer apartment, more dinners out, a better car lease. Nothing outrageous, just comfortable. But here's what happens psychologically. Your brain resets your baseline. What once felt like luxury becomes normal within weeks. The satisfaction fades. Meanwhile, your savings rate quietly drops, and compounding depends far more on savings rate than most people realize in the early years. Let's say you were saving 25% of your income before. After lifestyle upgrades, it drops to 10%. Your net worth still grows, but dramatically slower. The boulder is still rolling, just not accelerating. 5 years later, you look up and think, why am I only at $150,000? I thought I'd be further. Because you treated the starting line like the finish line. So what should you actually do at $100,000? First, secure your foundation. Build an emergency fund covering 3 to 6 months of expenses in a high-yield savings account. Liquid, accessible, separate from investments. This prevents you from selling investments during downturns. Second, capture every employer retirement match available. A 50% or 100% match is an instant guaranteed return. There is no investment on earth with better risk-adjusted returns than free money. Third, eliminate high-interest debt. If you're paying 20% interest on a credit card, paying it off is a guaranteed 20% return. That beats almost anything consistently achievable in markets. Fourth, maximize tax-advantaged accounts. Roth IRAs, 401s, Ks, HSAs if eligible. Tax-free or tax-deferred growth over decades isn't a minor detail. It's a compounding accelerator. Every dollar shielded from unnecessary taxation is a dollar that compounds longer. Fifth, automate everything. This is where wealth is actually built. Not in excitement, not in stock picks, in automation. Set contributions to happen automatically every month. Increase them automatically with every raise. Route at least half of every salary increase directly into investments before your lifestyle absorbs it. Remove willpower from the equation, because willpower fades. Systems don't. Now let's zoom out. At $100,000 invested at 8%, you generate $8,000 per year. At $250,000, that becomes $20,000 per year. At $500,000, $40,000 per year. At $1 million, $80,000 per year. Notice something? At $1 million, your portfolio potentially generates a full median salary annually, without you touching it. That's when the game truly changes. But here's the twist. You don't get to that level by becoming more aggressive after $100,000. You get there by becoming more consistent. The people who build real wealth aren't constantly optimizing. They aren't chasing new strategies every quarter. They aren't reacting to every market headline. They're boring. They own diversified portfolios. They rebalance once a year. They keep costs low. They ignore noise. They stay invested during downturns. When markets drop 20%, they don't panic, because they understand volatility is the price of admission for long-term returns. They understand that time in the market beats timing the market. And most importantly, they stay in the game, because compounding only works if uninterrupted. Pull your money out repeatedly, you reset the clock, slash your savings rate, you slow acceleration, chase trends, you introduce friction. At $100,000, your role shifts. Before, you were the engine, grinding, saving, hustling. Now your money is an engine too. Your job is no longer to push the boulder uphill alone. Your job is to clear the path and let gravity work. That means resisting the urge to celebrate with permanent expense increases. Resisting the urge to prove you're sophisticated with complex strategies. Resisting the urge to hide in cash because volatility feels scary. Instead, you build a simple system, and then you protect it. Here's the mindset shift. $100,000 is not a trophy. It's infrastructure. It's the foundation of a machine that, if left undisturbed, can produce financial freedom over the next 20 to 30 years. But the machine only works if you don't keep taking it apart. So if you're approaching 6 figures, or you're already there, ask yourself, are you about to get clever? Are you about to get comfortable? Or are you about to get consistent? Because the difference between $100,000 and $1 million isn't brilliance. It's behavior. The moment you hit 6 figures isn't the end of discipline. It's the transition from manual effort to leveraged growth. It's when your money finally starts working night shifts for you. And if you can protect that momentum, if you can stay boring while others chase excitement, you give compounding the one thing it needs most: time. That parking lot moment when you see $100,000? It's not a finish line. It's the sound of the starting gun echoing. And from here on out, the winner isn't the fastest. It's the one who refuses to leave the track. If you found this valuable and want more deep dives into money, investing, and building real financial independence, hit subscribe. And let's keep building smarter together.